It's time for In the Money, Stock Market Action on AM 820 News. Here's Chief Market Strategist Gareth Soloway from InTheMoneyStocks.com.
Good afternoon, everyone. Hope everyone is having a great weekend. I am here again, just like every Sunday, to reveal the inside secrets on Wall Street and give you true market projections here. And again, that's market projections as well as stock projections. And I want to just make one point about that first before we get into things. True stock market projections, it's different. All right, we're not talking about what you hear on the other financial media networks here. This is what has made me money nonstop, not what has lost a majority of the public money over the last 14 years or so, since the 2000 tech bubble collapse, 2007 financial collapse. You know, those type of strategies that keep wiping out 50% of people's portfolios just don't work. All right. Yeah, sure, the market has come back at this point. It is now sitting right around those all-time highs, but it's going to happen again. And I want everyone to understand that, is that, you know, history has a weird way of always repeating. And for us to think that it won't repeat at this point, especially after it happens over and over, that's the insanity of it all. All right. That's being insane when you expect a different outcome when time after time the same outcome arises. All right. So bottom line is the storm clouds are brewing, darker than I've seen in years. And a majority of investors have absolutely no idea. Hopefully, those of you listening will continue to take heed. Just like at the beginning of January, I warned about a pullback or a drop in the markets. That's happened. I truly believe that investors are getting a second opportunity here to take money off the table out of the markets to protect themselves. All right. And again, what I want to make clear on this is that it's not necessarily a situation where, I would say, you know, the markets won't give you opportunities to profit. You know, just a couple weeks ago, we ended up going long the market, and ultimately we were able to capture market action to the upside. And that was fantastic, okay? But one thing just to notice here is that you have to be nimble if you're going to do that. All right, there's two ways to handle this next market move, this next cycle, if you will. All right, number one, you have to be understanding and ready to be in and out quickly, which is what I like to do. It's called swing trading. The other one is if you're in retirement phase, if you're just not able to focus on the markets very much, then really honestly, I believe you should be in safety measures right now. You should be in cash. Okay, so again, I just want to be the shining light here in an otherwise dark room of deception. And I don't mean to build it up as something totally shady in that respect with Wall Street. It's just the nature of the beast. All right, the way things work, the most intelligent, those that have the most money, those that have the insight and can pay for the best service, they're going to be the ones that are in and out at the right times. If you're someone who's working a 9-to-5 job, you just don't have that luxury to be able to do that. So the point is, I'm here to try to help you. All right, Wall Street has a game to play. After each collapse, like in 2000 and 2007, they pushed the markets up dramatically over the course of a few years. All right, so this is just what happens, and I'm just giving you facts here. All right, you had a big collapse in 2000, epic collapse, dot-com bubble, tech bubble burst, markets collapsed, right? The markets then, from 2000 on approximately to about 2007, continued to move higher. All right, they just inched up day after day, week after week, month after month. All right, at that point, another 50% plus of the markets were just wiped out. And what happens here is just a psychological movement where after multiple years of gains, average investors who sold at the lows on the last collapse and now were too scared to get back in right away, they're finally regaining that confidence year after year as the markets move up. And you guys might find that what I'm saying here is very reminiscent of what you've experienced or what you've done, which is okay because that's the way it works. But I'm here to help you change that. Okay, so after years and years of upside in the markets, investors start to say, hey, listen, you know, everyone else seems to be making money. You know, maybe I should get back in. Well, guess what? Now those same investors who sold at the lows of the market collapse and were freaking out, they're now paying up 50% to get back in or 100% to get back in. And really, if you bought in 2013, you were basically paying up 100% plus from the lows of 2009. And guess what happens? Well, as the little investor buys into the market, the large institutions say, oh, there's buyers here. You know, we need buyers so we can sell into them. And the whole rotation begins again. Okay, and that's what I fear, and that's why I'm here to kind of enlighten you on it. And again, I want to make it clear that this isn't about you stepping back and saying, I'm never going to invest again in the world. If you do that, honestly, you're going to hurt yourself just as badly because inflation is going to continue. The Fed says they want 2% inflation, no doubt about it. I think down the line you're going to have a lot higher inflation. So if you're not making returns on your money of better than 2%, you're losing money, actually, in terms of buying power. So the option is not to just step out of the market 100% for the rest of your life. Now, in the short term, do I think that's the smart move with retirement money? Yes, I do, because I think the market's going to have a big correction. I think 2014 is going to be a choppy down year, maybe 15, 20% down from the highs. And then I think 2015 is going to be even uglier before we get an amazing buying opportunity in late 2015 into 2016. But that's more for later on projections, which we'll get to. But the point is, again, you have to start to understand how the game is played. And the game is played very simply by the institutions moving out at the highs to the small investor who are finally coaxed back into the market. And then they're the ones that are buying when the small investor is panicking and selling after losing 50% of their money at the lows. And this cycle repeats over and over again. And just look at history. I mean, I just go back to 2000 to 2007, then 2007 to this current period, which, by the way, is a particular year setting each time, which I'm not going to get into. That's more cycle work for those of you that are into stock market cycles. But it just repeats and repeats, and you can go back to the 90s, to the 80s, to the 70s, to the 50s, to the 30s, and it repeats over and over again. So the point is, it's just a shame because I look out there and I see these little investors and these people that work so hard for their money, 10 times harder than a majority of Wall Street bankers who are making millions every year. And they're the ones that are just getting that money taken from them as the markets flip-flop back and forth in these cycle moves. So it's time to step up. Step up and just learn a little bit about the game so you can avoid it. That's all it is. You just have to be a manager of your money in a little bit of a sense. Okay? All right, guys, and right off the bat, I want to go to a phone call. Craig from Ybor City calling in. How you doing, Craig? How's everything going?
Hey, fine. I wanted, about 3 weeks ago, I spoke to you about CNTF, China Tech-Based Wireless.
Yeah, I remember, absolutely.
And it did exactly what you said it was going to do. You said I'd get down around that $1.70-something area, because it was about, it was going to, and it backed off right to where it is. Now it's on the upswing again, or so to speak, and it's trying to get above that $2 range. So CNTF, I bought a little bit of it. I didn't go too far overboard. Now, to bring it up, now a while back I told you there's a couple of guys I heard on the radio, who were with, I don't want to mention the companies they're with, but they're pretty hot on this thing. Remember I told you they expect this thing to eventually, not right away, but down the road to be the next Apple of China. That's how much faith they have in this company.
Right.
Well, I heard another guy with another company the other day say the same thing, and I want to get your thoughts on it. They think that this thing is perfectly situated, being it's in China, and the stuff that they're doing and whatnot, that they expect this thing to start to rocket down the road. And they didn't say tomorrow or next week, but they just said get in a little bit there. It's a cheap enough price, and just hold on to it for a while. I know you're not a buy and hold guy, but
yeah,
they're basically saying, they're not telling you to put your whole bank account into it, but
of course,
just put the money aside on it, and this thing should work out for you down the road, hopefully.
All right, let me
what do you think?
let's just look at it again. So I just put up the chart in front of me here,
that's CNTF.
Yeah, and I just brought up the chart in front of me, and number one that I see, it pulled back just like I said it did, and I'm glad you called back up because it brings up some of those same informational pieces that go into how I find these levels. And a lot of people I talk to say, oh man, what you do is like witchcraft or hooey or whatever. And the point is, it actually does work, and you can read the charts really accurately.
I think when I spoke to you, it came off about 223. It got up to intraday. And I think when I called you, it was right around $2 or $1.99 or something. You said it'd probably get down to about $1.70 something.
Yeah. It happened to be just for everyone listening at home or in the cars. That happened to be the 200 moving average, and it's also a fib retrace level right there. And we talked about fibs a few weeks ago, which are very important. But anytime you get a pullback, and first of all, you never buy it high. So if you see a stock, I don't care if it is the next Apple or not.
Yeah,
anytime you see a
or
vertical
even if it's
move,
Apple, you do the same thing.
Yeah, exactly. Same thing with Apple. You wait for that pullback, and once you get that pullback, then you get to make that decision. And I think in this situation, again, I think you bring up a good point, is that, listen, if you're someone who likes to take a little bit of extra risk and you understand that you're dealing with a very small company with a lot of risk, then by all means, you can give it a little bit of a shot. I'm not sure whether or not it will be the next Apple. I think a lot of people tend to throw terms around like, they're going to cure cancer, or they're going to be the next Apple, very much so. But But
I know their products. I look at the product stuff. They seem to be pretty interesting stuff they make.
yeah.
But what's it look like going forward from here? I mean, does it look like it's going to struggle at this $2 mark, or does it look like it's going to pull back again, or what's the deal?
Yeah, well, right now, basically, all right, so we had a big move up, and this is getting into a little bit of technical analysis, which, by the way, folks, is the way I trade, the way I find my levels, is using the technicals of the charts. And number one, it moved up dramatically before I talked to you, and then it had that nice pullback to the 50, which was your buying opportunity. Now, since then, it's come back up and still is hammering. Notice how it hasn't been able to take out that previous high yet at around 215 to 220. Yep. So that's your marker. And what I would say is watch for that. All right, if it breaks that, then I would be a buyer. All right, so basically, it's right around $2 right now, so you're only dealing with 15 cents, but 20 cents. But if it can get above that and close above that, then I think you're in breakout territory. But aside from that, right now, especially with the way I feel about the market, and this is the same feeling that I got in early January about the market when I was saying, be careful, be careful, be careful. Something's going to happen here, and then we dumped about 7% in a matter of 2 weeks or so. So it's the same feeling there as I'm getting right now. In fact, it almost scares me more because I see this big rally in the market that we've just had, and it almost brought us back to the all-time highs on the S&P and on the Dow and such. And I see the small investor thinking that was the pullback, and then they have to pile in on the long side. And that is so concerning to me because that is part of the game. All right, that buy the dip mentality has been ingrained in the small investor. And at this stage of the game, it's a concern because you have these small investors that are now piling back in, and ultimately you're looking at another major down move coming in the future. So be very, very careful on this market. And with CNTF, again, I would look if he breaks above 220. I think that's golden right there. But aside from that, I'd step back and just kind of watch for that. Okay. All right. What we're going to do here, we got to jump into a commercial break here, but I'll be right back. We'll do some more analysis. We'll talk to some more callers. And again, folks, you're listening to In the Money Stock Market Action on 820 AM News Talk Radio.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
Welcome back, everybody. Hope everyone, again, is having a wonderful Sunday. A couple things to do. Number one, I want to give out the call-in number if you have a question on a stock that you'd like to go over. The number is 866-977-4820. That's 866-977-4820. And again, one other thing I want to mention here is that if you're interested in being a sponsor of In the Money Stock Market Action, the most riveting show on the radio, telling the truth on Wall Street and really helping the average investor profit in any market, up or down, I do encourage you to give us a call at this number. All right, 212-380-1578. That's 212-380-1578. Or you can email support at InTheMoneyStocks.com. And again, I'm Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. I've been trading for well over a decade at this point in time. I've studied the markets. And again, when I say trading, folks, I want you to understand this isn't being a broker type nonsense. All right. And when you're a broker, you're basically pigeonholed into getting calls from the higher ups about what they want to push to you, and then you end up pushing it to your clients. What I do is I find stocks that make sense to me that I am putting my own money in, and then I give them out, to the members of InTheMoneyStocks.com. If I'm not willing to put my own money at risk on a trade, I'm not going to give it out to my members. It's just that simple. Because, if I'm going to believe it in enough that I think it's going up, obviously I want to profit with my members. It just makes sense, right? So I think that's the big key here to understanding the differences in what I do versus what a lot of Wall Street does. A lot of Wall Street likes to talk big and push stocks and so forth, and I think it's important that your money is where your mouth is in situations where you're trying to help the public because, again, it shows dedication and it shows that you actually believe in what you're doing here. All right, so number one, again, if you want to be a sponsor, that was your number. If you want to call in and just ask a question, 866-977-4820 on In the Money Stock Market Action. Now, first off, what I want to do right here in this segment is just rehash what we discussed last week in that interview with G. Edward Griffin. Just a genius in regards to what the Federal Reserve is truly about. And a couple things that I thought were very interesting that were worth rehashing. Number one, look at what the Federal Reserve was supposed to do. Federal Reserve was created in 1913. And leading up to 1913, there were a bunch of issues with the public. The public basically had an outcry, and they said, listen, these big banks are controlling too much. And you're going to hear a lot of normal themes here that are still consistent in today's environment. Okay, and this is what I think is so scary about the Fed and what they were supposed to do and who they really are. So in 1913 and leading up to that, the public was crying foul because these big banks were controlling far too much. Okay, and basically the big banks got together and said, hey, listen, why don't we create a body that is supposed to control us and the public thinks will control us? And in this way, they won't know the difference. The public will be fooled. And we'll say we have controls, but really what we'll do is just continue to do our normal thing of making billions and billions and trillions of dollars. So, Rothschild and a bunch of these other players, J.P. Morgan, Rockefeller, all the big players back in that time got together and they created the Federal Reserve, on Jekyll Island, which again is G. Edward Griffin's book, The Creature of Jekyll Island, which is a must read. I can't stress that enough. So they got together and they created the Federal Reserve, and ultimately they were supposed to be policing themselves, but it's like, how are the police going to police themselves kind of thing. And, bottom line is they told the public that there were going to be no more bubbles. There were going to be no more collapses. Things would be smooth sailing. And it's funny because I feel that over time, more and more bubbles have been created because they've been essentially bailing out themselves over and over again. And I guess in 2007, 8, and 9, when they got bailed out, just another example, while the little investor hasn't been bailed out at all. If you lost your account in 2007, 8, 9, and 10, and so forth, I don't think any of us got a bailout. None of us did. Instead, our tax dollars, so it's actually a double negative because not only did these big banks get bailed out, but then our tax dollars went to it. And I mean, again, this is the situation we live in. So it is concerning to me, and I think it's just questions we all must ask ourselves. It's stuff that we have to say, listen, is this something we want in our society? And I'm not saying to necessarily do away day one with the Federal Reserve, although I think the downward wind would be an optimal end game, but I think it has to be done in the right way. But I think as a general public, we have to start asking questions. I mean, all we do is listen to the media and even the politicians over the last couple months praising Bernanke for saving the day. All right, and I think that's a bigger concern too because Bernanke in himself, right? When he did his doctoral thesis, and this is getting a little bit out of range here, but I think it's important to mention as well. So early on, Bernanke did a doctoral thesis, and his doctoral thesis was on if you print enough money, and if you had printed enough money during the Great Depression, you could have avoided the Great Depression or shortened it so significantly that there would be no issues. So this is a method. I want to make this clear. What's been done over the last few years has never happened in history before. All right, not to this scale at least. And his doctoral thesis, it's funny because he's actually trying to prove his doctoral thesis, but it's happening in real time. I mean, this isn't just a laboratory experiment. This is an actual experiment that we're going to find the effects of. And I think, we're all waiting to see, and I'm fearful of what the end game will be. Now, what will the end game be? Well, ultimately, right now we see no inflation. No inflation really to speak of, maybe minor inflation over the last couple of years. I think with food and energy, we'd all agree that there is some inflation there, especially those middle class and lower income families are really feeling the pinch at the supermarket and somewhat at the gas station, although I don't think as much over the last year or so. But the point is, down the line, this is when the you-know-what is going to hit the fan, and that's what concerns me. Because why hasn't there been inflation? I mean, that's the question, right? All right, so they've printed $4 trillion. Why hasn't there been inflation? Well, very easy. I can tell you this right off the bat. There's no inflation because the amount of money they have printed is equal to or even less than the wealth destruction that occurred from late 2007 through 2009. Just think about housing alone. You had houses that were valued at $500,000 out there, or $1 million, that were cut in half. So if you take every house out there and cut that in half in value, well, that negates the $4 trillion they've printed. Okay, so net right now you're at no inflation. There's no extra money in the system per se. All right, but the issue is as housing prices start to come back, which they have started, which is great. Listen, I'm all for housing prices going up. But my concern now is that all that extra money is eventually going to flow into the system. And by the way, this is a global issue because Japan's doing it, China's doing it, and China's another story that is just scary. But all these countries are saying, hey, listen, you can't devalue your currency faster than me. I got to devalue my currency faster because, if your currency is worth less, then you're going to start, producing more goods in your country and selling them. And we want to make our guys have jobs on our side and produce more goods. And I know it seems a little strange if you don't understand currencies and how things work, but the country with the the cheaper currency relative to other countries, that means that they're going to produce more goods because it's cheaper for other countries to buy those goods. So there's a supply-demand shift there. And for the longest time, it's been in China, right? I mean, Chinese workers are getting paid pennies on the dollar compared to U.S. workers and so forth. So China doesn't want our currency to be deflated, and they don't want more printing of money here because it means that they're going to lose jobs there. And it's like a global kind of shift. Which country can devalue their currency faster to kind of take jobs over to that country? And again, the question is, are these jobs that we want? All right, are these, $5 an hour type jobs? And granted, the minimum wage is obviously higher than that. But my point is, are these low-paying jobs? Is that what we want? Or do we want to start investing in bigger technologies, jobs, other jobs that are going to pay more money? And I think that's what it comes down to. But, bottom line is, these questions must be asked over and over again. And I really feel that the average American is brainwashed by what is going on out there. All right, you're not hearing about the true nature of the printing of money, the true effect long-term of printing this much money. Think about what it does to any country. I mean, look at Greece. In fact, look at Puerto Rico right now. Puerto Rico right now is like the Greece of a couple years ago. And the only reason these countries are surviving is because they keep getting bailed out, which is more money printing by the bigger heads, which all ultimately devalues our own currency and makes our buying power less. But the U.S., right? I mean, just look at you in terms of a household. If I were to just run up thousands and hundreds of thousands and millions of credit card debt, what's my end game? Okay? Well, I mean, we can all look at ourselves and say, well, what would my end game be if I had that? And the answer is very simple. We would be in a lot of trouble, and eventually we would go bankrupt. And I fear that even though the U.S. is the strongest entity out there, the more kind of debt that we accumulate, the more money we print, the more that the government raises this debt ceiling, which happened last week, eventually the house of cards will come down. So let's start waking up. Let's think how we can protect ourselves. Let's get into motion, and let's do something about it. All right, folks, what we're going to do here is take a break for a little news break, but one more time, I encourage you to start thinking about things, and this is In the Money Stock Market Action on 820 AM News Talk Radio, and we'll be right back.
Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
Welcome back, everybody. Second half of the show here on this Sunday, and I truly hope everyone is having a wonderful weekend. Just remember, markets are closed on Monday in observance of the President's Day holiday. So, again, don't expect market action on Monday, which, again, is going to pigeonhole the trades this coming week into a 4-day span, and we'll talk about a little bit about that in a short amount of time. All right, so I think again, what I want to do in this next segment is start getting into the actual market from last week. I want to get into trading tactics. I want to get into the new calls. I want to go over last week's calls and kind of give you guys the what to expect in the coming days in the market. And I kind of talked about it earlier in the show that I really see dark clouds on the horizon, guys. This rally that we've seen off of that big pullback right back to the highs in such a short amount of time is not healthy, number one. And number two, I fear it's getting the small investor to re-engage in the market. So maybe there were some investors that were on the fence about putting money in the market on the pullback, and now here we are back at the highs, and they're saying, oh, darn, I missed buying at the exact low, and now I feel like I'm going to miss out on the next leg up, so I've got to get in the markets. And I really worry about that mentality, folks. So right off the bat, be safe. I'd rather have you safe than sorry, right? I mean, think about in 2007. If you had, I don't know, even just $10,000 and you were about to put it in the market in 2007, and let's say you did, well, ultimately that $10,000 was worth $5,000 a couple years later minus inflation, which means probably buying power of about, I don't know, $3,000. And wouldn't it have been better just to be out of the market and let the market do its thing, even if it went up another 10% before it collapsed 50%? And I think that's the goal here, is we have to look at both sides of the coin when you're investing. Too many investors look at a stock and they say, oh, man, this thing could go up 100%. And they don't say to themselves, wow, well, the chances of it going up 100% are 1 in a million, but it could drop 25%, and then I'm going to be pretty upset. And the likelihood is it drops 25% more likely than it goes up 100%. So what am I really doing here? What are the odds? When we all sit down at a casino, you go in expecting to most likely lose. I mean, at least that's the mentality you should have because the house is always going to win there. But in the markets, you have a rare opportunity to actually have the odds in your favor if you analyze stocks correctly. All right, and again, that's what we do at InTheMoneyStocks.com. And again, you can go there and check us out. Before we get into a little bit more analysis and talk about last week, I just want to give out the phone number again, 866-977-4820. That's the call-in number to ask a question on the markets on this In the Money Stock Market Action show. And again, just one more time, if you're a sponsor, if you own a restaurant in the Tampa Bay area or anywhere in Florida and you're listening, if you own any sort of business and you'd like to be on the radio, more than happy to have you as a sponsor. And again, the number is 212-380-1578 for sponsors. If you'd like to be a sponsor of the show, just give that number a call, 212-380-1578. All right, let's talk a little bit about last week. So first off, last week, I was a little surprised at the extent of the move to the upside. All right, so I knew the market would get a little bit more upside in it. I said that last week when I gave you a potential pullback on the S&P around the 1805 level. But instead, the market just continued to go up all week. So what was behind that? Well, there were a couple things. Number one, Janet Yellen testified in front of Congress early in the week. I believe it was on Tuesday. And Janet Yellen is the new head of the Federal Reserve. So basically what we saw from her was it was her first debut in front of the public. And not only that, but she had to deal with some tough questions from Congress, really. All right, and it's from these committees and so forth. And in all fairness, she handled herself very well. And I think the market kind of cued from that and said, listen, if she can handle herself well, we're in good hands. Bernanke handled himself well. This was the first showcase of it. And all of a sudden, you kind of had a little bit of a risk factor taken out of the markets of that she was going to get up there and kind of blow up. And I don't think in reality, was there a chance that she was going to blow up? No, obviously not. I mean, it just wasn't going to happen. She was going to handle herself generally well. But I think the market just said, all right, listen, this is better than we expected for the most part. She seems to be able to talk well, kind of handle these congressmen and so forth. So that was a nice way of kickstarting a little continued rally early in the week on Tuesday and going forward. What we had later on, we had some bad economic news. We had retail sales coming out, I believe, on Thursday. The markets actually had a pretty ugly gap down that morning on the back of that economic news. But very quickly, the markets reversed on Thursday. They went from being down 12, 15 points on the S&P pre-market to actually being up about that amount. And a lot of people were scratching their heads and saying, well, bad economic news, what's going on here? Why is this good news? And there were a couple reasons for that, and I just want to explain so you start to gain a mentality for investing in this market. And that's really what it's all about. The mentality has to be correct of why you're reading things and what's going to be good news, what's going to be bad news. And in reality, if bad news continues out, and we've seen a fair amount of poor economic news, the market's holding on to a little bit of hope right now that the Federal Reserve will pause on their tapering. Now, if you recall, the Fed has tapered $10 billion. They've pulled back $10 billion per month here since December and into January. All right, so $10 billion each month. All right, on their tapering. And remember, starting a while back, they were printing $85 billion a month. All right, I know it sounds crazy, that amount of money, but that's what they were doing. All right, they were printing that money and forcing it into the economy through the banks. And by the way, the banks get a nice hefty, thank you bonus on that one and get to put a lot of money in their pockets as well. But they were pushing that into the markets. They cut $10 billion off in December, and then in January, February, they've cut another $10 billion. So it's down to about $65 billion. The markets act like this is a drug. So one of the reasons why you saw a little bit of craziness in early January is because they cut again on that tapering. And the markets look at QE as a lifeline. Think about life support, or think about, I use this example because I think it's a very relevant example, kind of a drug addict, right? All right, so a drug addict is used to the certain amount of drugs, and they usually have to up that drug to get the same high. But what happens if that drug starts to taper off? Well, all of a sudden, that drug addict is going to freak out. They're going to just go nuts, right? I mean, it's the withdrawal symptoms. And that's what the market does, or is kind of doing. And so what the market's hoping here with this little bit of a continued bounce this week was that, hey, listen, maybe the Fed will stall and not cut us off here totally. And again, that creates a little bit of rally. You throw in the buy the dip mentality from the average investor. One concerning factor, there's a million concerning factors here with the bounce up, but think about the volume aspect. All right, is this a high volume bounce or a low volume bounce? And the answer is it's very low volume. Well, what does volume mean? Well, volume is the amount of shares being traded. So every day we can say it was high volume or low volume or middle average volume. And that's the amount of shares being traded. So it tells you the participation in the markets, how many people are in the markets. And when it's heavy volume, The only way it's going to be heavy volume is if the institutions are participating. All right, this is important because they make up so much of the liquidity of the markets, billions, trillions of dollars, that when you see a heavy volume day, you generally know, okay, the institutions are buying here, right? That makes sense. If the institutions are buyers with the average investor, which we know is buying right now, then it should be a very high volume day. But none of these bounce days have been high volume, which to me tells me that the little investor is, swallowing the hook, line, and sinker and going into the markets, while the institution's staying back. All right, probably the institution's slowly selling into them. And again, think about that. Do you want to be participating in a market if the institutions are not buying? No, I don't. Time and time again, decade, century, whatever you want to go back to, they're the ones that have always been right. Well, except in 2007 where they over-leveraged themselves, but then they got a bailout anyway. So for the most part, you want to be on the same side as the institution. If you're not, then you're going to be most likely in trouble. So the light volume bounce up here has to be very concerning to the average investor. And it's concerning to me, and that's why I'm bringing this to your attention. A couple other things. I've mentioned this before. I'll mention them again. The margin levels, all-time highs. What's a margin? What's margin? Margin is the amount of money that you're able to borrow as an investor to invest in stocks. All right, it's basically a gauge of the overextended nature of the average investor. All right, institutions that we're not talking about them. They have enough money where they don't necessarily have to use massive amounts of leverage. But the small investor with a $10,000 account might be interested in using leverage, which would be 2 to 1 in terms of margin for overnight holding positions. And they might be able to put $20,000 in, which is the 2 to 1. So for $10,000, you can invest $20,000 in a margin account. I don't like margin, by the way. I think margin is a horrible thing for the average investor because they charge you a interest rate on that. So if you're just holding long term, you're basically losing money because you're paying that interest rate every month or so. So I want to make that clear. I don't agree with margin right off the bat. I think it's a poor idea for the average investor. But the point is, investors are doing it, and therefore we need to read into that. And the level of margin is at an all-time high. And I said this before in past radio shows, but the last time it was at an all-time high, 2007. Well, what happened in 2007? Started in 2007. All right, before then, when was the next all-time high? In 2000. Well, what happened after 2000? So these type of signals continue to be worrisome. I've mentioned it before as well. The market action on the Dow is identical to 1928-29 before a major collapse came. So, I mean, again, we talk about cycles, and we've talked about the collapse cycle, in 2000, then again in 2007, and here we are in 2014. Everyone should be able to pick up a pattern in that. All right, and then we look at the markets and their price action compared to 1928-29, mutual fund inflows. And then the other thing I wanted to bring to your attention here that I think is big is the headlines on the news. All right, and this is important, guys, because this is one of the biggest contrarian, and contrarian means it's the opposite. So if someone, essentially, if you go contrarian on something and someone says buy, then you go contrarian, which would be sell, right? So what I'm seeing, and I saw this weekend on Market Watch, which is one of the major financial online mediums there, the quote, the headline was, is fear making you too conservative? And right off the bat, what is that implying? It's implying that retirees, especially, that's what they were gearing it towards, retirees are too conservative. Okay, well, were retirees too conservative in 2007 before they lost 50% and had to go back to work? I don't think so. So now we're happen to be at all-time highs again, and these headlines are coming out. So when I see headlines like that, is fear making you too conservative? Right away, I'm thinking that the average response from the individual when the article is about putting more risk on is to put more risk on. While the average response should be to pull back and say, whoa, look at these headlines. And you might say, well, that's kind of weird to think that these headlines mean that much, but think about this. All right, in 2007, Time Magazine debuted a cover which was focusing on the housing bubble and how awesome it was and how it was just rocking and rolling and how you could make so much money on housing. And literally 2007 was the top. And if you go back to every major top on a market, there's some major news story or multiple on different magazines and online print now these days that will be saying this is the greatest thing ever, markets at all-time highs, the greatest time to invest, et cetera, and then that is when the collapse occurs. So I want to ingrain this into your brains. When you see a headline on a major news outlet talking about something huge, in regards to investing, it could be housing, it could be stock market, it could be an individual stock, start going or thinking the opposite way. I promise you it may not be the exact top, but it will be close to the top. All right, and again, guys, so unbelievably important. So bottom line is, going back to last week, the market actually did extend more than I thought, although I think that's a very negative signal because obviously it's making the average investor more bullish. And we have to start loading up. I'm actually doing this with my members at InTheMoneyStocks.com. I'm actually accumulating shorts, and I did this all last week, folks. I basically picked up one a day kind of thing, slowly inching in. It's basically like dipping your toe in the water. Now, what's shorting for those of you that are new to this radio program? Shorting is where you make money when a stock goes down. So normally, the institutions only want you to know about making money as a long-term investor. You buy and hold, and that's it. But meanwhile, they're making money on the up moves, on the down moves, on the up moves, on the down moves, and they're just cleaning up. And what they use you to do is they want you to be buyers at the highs where they can sell into, and then when the market crashes, they want you to just dump it. Well, what I want you to do is be buyers at the lows, be sellers at the highs, and then short the market and make money on the way down again. And just rinse and repeat, up, down, up, down, up, down. And you can do that. That's what we do. And it's time the average investor starts analyzing and making money the correct way. All right? I mean, I know there's a bunch of things, it's not patriotic to short. Honestly, that's nonsense. That is absolutely nonsense. That's what the media and the institutions want you to believe. If you want to believe that, keep your head in the sand. All right? Because the institutions are making billions of dollars, and they're just laughing all the way to the bank. So step up and start investing correctly. You know, there's a game being played. I said it at the beginning of this show. And you have an opportunity to participate. All right? Your option is not to just stay away from the markets and put your head back in the sand and just say, I'm never going to invest again. Because then, as I said, you're going to lose money by buying power based on inflation. You've got to invest. The key is learn the game. They don't want you to know the game. I want you to know the game. Okay? So we're gonna take a little break here, folks. But before we do, next when we come back on the final segment, we're gonna go over last week's trades, and we're also gonna go over the coming week's trades. We're gonna see how much money is donated to charity, and I'm excited again because we have new plays for you. That last week was a fantastic week again on the trades I gave. And again, this is In the Money Stock Market Action on 820 AM News Talk Radio. Be right back, guys.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
All right, back here for the final segment of the day, and hopefully, again, as I said, everyone's having a wonderful Sunday. Just a reminder, folks, if you do own a company or if you want to be a sponsor of In the Money Stock Market Action, make sure to call us at 212-380-1578. Again, we are open to having a few elite sponsors. I don't want a lot. I want one or two, and I think that'll be perfect, and I'd ideally like it to be great things in the Tampa Bay area, which I know a lot of you guys have out there. All right. Now let's get into some stock action today. So everyone's been waiting all, and this is why, by the way, I put it towards the end because I know you all want it so bad. I want to make sure I put the stock picks and such at the end of the show so everyone kind of stays through and learns the entire action of what's truly going on in the market. But let's go over last week's action. So again, last week, again, as we said on the markets continued to grind higher. The S&P hasn't taken out the highs yet, so I want to make this clear. That's your key level. All right, watch the S&P on a closing basis above the all-time high, which I think was around the 1850 level. If you recall, in early January, there was major institutional selling at that level, which is one of the ways I could see and tell you guys that we were going to have a big pullback there. So watch that same level. We closed on the S&P at 1838.63, so we're really only about 11, 12 points away from that 1850 high on the S&P 500. All right, Dow was up 127 on Friday. NASDAQ up 3 points, 3.35 to be exact. And last week, the NASDAQ actually did outperform pretty nicely. All right, so let's go over last week's plays. Let's find out how much I am donating to charity this week, which, again, is always a pleasure to do, even though it means I did not perform on a trade I gave out. I'd rather, at least always, as I said, the charity should benefit. And, again, Metropolitan Ministries in Tampa is the one that at the end of this quarter I will be writing a check for the entire amount over the quarter of $100 per missed call. Okay? And again, the beauty of it is I'm a rock star out there in terms of Hall of Fame action, and I give you guys a majority of winners, but occasionally I'll be wrong just a little bit, and that's just the nature of the beast. Anyone who says they'll never be wrong is definitely lying to you, folks. All right, everyone, even the best of the best, is going to be wrong once in a while. All right, last week, let's go over these trades. And by the way, just one more thing. Remember, as you guys are making money, which I know you are because these trade alerts that I'm giving out are overall making quite a bit of money, I really do encourage you to donate a little bit of that profit to charity. I'm telling you right now, it'll come back around 100 times. You help someone, you feel better, and additionally, I truly believe that you do better financially by doing that. I know it's counterintuitive to think giving away money will make you more money, but I've always experienced that it has. And interestingly enough, as I've been doing this, I've been making more and more money in the market myself. So it truly shows that. All right. Last week, I gave out a long on corn, which we've been holding. Basically, every week I've had CORN, which is the ETF that tracks the corn price. I've basically been high on this one for quite some time. And last week, it was basically flat. It technically was down 12 cents, which is less than 1% down, but nonetheless, based on that, a flat trade, we'll call it. I'm still going to donate 100 to charity for that one, all right? Unless it really makes money, I'm going to donate. Even if it's flat on the week, still donation goes to charity regardless, okay? Next one was JCPenney. Now, JCPenney's my quarterly play, which at the end of the quarter, based on the beginning when I first said I liked it, that'll be, if it's higher, that's awesome. If not, then I'm going to donate $500 to charity. But last week, I also gave it as a weekly play. I said, listen, the chart setup here is perfect for JCPenney. The price action's perfect on it. This stock is going to go higher. All right, and sure enough, JCPenney at 551 was given last Sunday. It closed at 614. Check this out. In 5 trading days, JCPenney was up 11.4%. So far we've had a flat trade and an 11.4% profit trade. All right, those are 2 of the 5 trades so far. So right now we're rocking and rolling. All right, the next one I gave was silver. I said silver is a rock star here. This one's ready to go. And I gave it out at 1927 on the SLV, which is the tracking ETF for silver. And you can all pull it up on your charts on Yahoo Finance, on Google Finance, wherever you are. SLV is the symbol. And I gave it out at $19.27. And the stock closed on Friday at $20.65. That's a $1.38 gain on that ETF in 1 week, 5 trading days, or 8.72%. So all of a sudden, out of 3 trades, it's a 1 flat, an 11.4% winner, and an 8.72% winner. This is in 1 week, folks. All right, the next one was SGG. All right, I said on SGG it was only valid when it got to $52. And SGG is sugar. It's the ETF for sugar. So again, for those of you, sugar's a commodity, right? But not everyone can trade commodities, but pretty much everyone can buy or sell an ETF or a stock. It's the same thing. So that's why I give the ETFs for them. All right, if you're a commodities trader, then you could play the commodity itself. In any case, SGG, if it pulls back, I said on Sunday, to $52, it is a buy. Well, sure enough, within the first day or so of the week, it pulled back to 52. Off of 52, it had a huge jump up. And again, it ended up closing at 52.67. That's a 67-cent gain, or 1.3%. All right, so now we're dealing with a flat trade, an 11.4% winner, an 8.72% winner, and a 1.3% winner. All right, next up, the S&P 500. And this was one I was off on. So of all of them here today, this is the one I have to kind of eat my words on. I assumed we would have a little bit more upside earlier in the week, and it ultimately went up higher than that. And we closed on the S&P after I said 1805 was the shorting level. It went to 1838, which was down. It's a loss of about 1.82%. So overall, after making 11%, 9%, and flat, and 1% and so forth, it basically just takes a little bit of steam out of that. But for the most part, again, folks, we're talking about a 20% gain net on last week's trades. If you put just 20%, well, since 5 trades, 20% of your money in each of these plays, you would have made over 4% on your account last week. Think about that, folks. So if you divided up your account of, let's say, $10,000 or $100,000 equally between all of these trades, you would have made 4% return in 5 trading days. That's a 200% plus return per year. And this is just normal, folks. This is what I've been doing every week, essentially, here, giving you out these plays. All right, so I just want to kind of reinforce that. I'm not going to be perfect, but notice how the ones I'm wrong on are wrong small. All right, that's okay. All right, so you lose 1% there, but you made 8 or 9% here and 12% here and so forth. So be it. All right, I have my next plays, but before we get to that, based on the flat trade of corn and the S&P being incorrect, that's $200 more to charity, okay? And what's nice is that I'm donating to charity, but all of you should have made money anyways, so hopefully you're donating as well. And again, this way, as I said, the charity should always win. All right, I may not always win, you may not always win, but hopefully the charity always is coming out ahead as it should be. So $2 more $100. That brings so far for this quarter my total of donations to $850. By the way, remember, $150 was a match donation to a caller we had a few weeks ago who donated $150. I said I would match that. So in that $850 is that $150 as well. And again, that's $850 so far for this quarter. And at the end of the quarter, we'll be writing a check to Metropolitan Ministries. And then the next quarter, we'll choose a new charity and kind of just do it that way. All right. Good week last week. Let's get into trades this week. All right. Right off the bat, I'm going to remain bearish on the markets. I've seen this game played over and over again, folks. Even though it's a short week, I can't foresee the markets really having significant upside here. There's too many possibilities. There's too much price to perfection nature in this market. The one thing I'm going to do here, folks, is I'm going to adjust. Because it's a 4-day week, it's even harder to box myself in. So what I'm going to do is I'm going to make these plays good through the end of February. So these next 5 plays, they're not going to be closed out per whether they're winners or losers until the last day of February, which is not this Friday, but the following Friday. So I'm just going to give them a little bit more time because I can't box myself in. 4 days is tricky. 5 days is tricky, actually. 4 days is even trickier, especially coming off a holiday. So again, what we're going to do is these next plays, and I'll give you more plays next week anyways for that 1 week period. But this way, again, we can give it a little bit more time, and I think you'll get a better bang for your buck out of it as well. All right, your first play, S&P short again. We're going to take the closing price from Friday at 1838.63, and S&P should go down. All right, I'm miffed at the amount that they were able to push this market up, although, again, considering the snowstorm, which kept traders at home, considering buy the dip, considering Janet Yellen, all these factors, I guess that's the nature of the beast, but it really should not hold up. All right, this is, to me, a classic fool's gold type rally where they're going to pull the rug out from under people again and collapse it down. So, again, short S&P 500, 1838.63 per the close on Friday. You can short the SPY, which is the ETF that tracks the S&P 500. Also, there's a 2-time short ETF that you can buy, SDS. There's more risk there because it's 2 times. You're getting 2 times the bang for your buck. So you can make more, but you can also lose more. Be aware of that one. The next one, I'm going to stick with SGG as a long. So we had SGG long last week. I'm going to stick with it this week. Okay, so SGG and S&P 500. I'm going to stick with corn too, CORN. Let's keep going with it. All right, it's basically been flat or green for us every week since we gave it, and I'm going to continue to go with it. I like the chart. The chart's actually a beautiful thing, as is the SGG chart. So those 3 so far. So we have a short on the S&P, a long on SGG again, and a long on corn again. The next one is a short on the QQQ. The QQQ is the NASDAQ tracking ETF, NASDAQ 100 ETF. So I'm going to go short on the NASDAQ as well. And the last one is going to be a VXX long at 41.95. So Q's short at 89.81, VXX long at 41.95. Okay, so there's your 5 plays. And again, as I said, these are going to be closed out on the last trading day of February. Because it's a short week, it's only a 4-day week, so that would only give us till about the 21st from the 18th when the market opens, which is just 4 trading days. So we're going to have these extended be basically a week and 4 days trades. And what we're going to then do is move over, and I'll give more plays next week just for that last week as well. So you'll actually, going into the final day of February, you'll have a total of 10 plays out there. All right? And this is what, again, it's all about, folks. I just want to bring the truth to you. I want to give you hardcore analysis that can make you money. This is stuff that you're not getting anywhere else. All right, you're going to get pumped and dumped over on all the other financial networks, and I want you guys to be on the right course. I want you to learn the game. I encourage you to come to InTheMoneyStocks.com and profit with us. Check us out. We have a 7-day free trial. And again, folks, it's been a pleasure to be with you. My name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com, and this is In the Money Stock Market Action on 820 AM News Talk Radio. Take